It's a pleasure to be here. And indeed, my talk today links to some of the topics Andreas just mentioned. In particular, the depression babies topic will come up a few times throughout the talk today. So broadly speaking, what I'm interested in conveying today is this still relatively new concept that for economists, new concept, that past experiences shape us as humans in our risk attitudes and beliefs in a lasting manner, which is not captured by the existing neoclassical models. So if we think about the traditional neoclassical model of economic decision-making, let me highlight three elements in there. The typical Homo economicus would be born into this world with a certain set of preferences. He may like certain goods more than others. He may be very averse to risk or more risk-loving. But once the human is born that way, the human walks through life having these preferences and maximizing these preferences. He or she will update her beliefs about the world. She will learn about variables that have uncertainty, but does so in a very rational manner using Bayesian updating. And he or she is doing all of that with perfect cognition. So all the information you throw at that person will be incorporated into new beliefs and in finding optimal decision in a perfect way. Now, of course, economists have long criticized that, in particular behavioral economists, this area where I fall into, and argued that that doesn't exactly give you a realistic picture of how humans make decisions. Now, the particular aspect I want to focus on today is the role our personal lifetime experiences play in shaping us as humans, our preferences and our beliefs. In the traditional economic way of modeling decision-making, it doesn't matter whether there's a certain outcome, like an economic crisis, illness, disaster that strikes, natural disaster that strikes, about which I learn from written information, from otherwise conveyed information, or whether I live through it myself, as long as I only hold the standard economic determinant constant, as long as we can hold wealth and income and employment prospects and education. I mean, lots of things might be affected by those events, but if I can hold them constant, the prediction is I'll just function just the same way, whether I learned about how the economy works from written information or whether I personally experience certain outcomes. For example, going towards the depression babies theme here, living through an economic depression, think about the recent financial crisis, living through a financial crisis will not affect my attitudes towards financial investment any different compared to me just reading about it, learning about it in a class here in college, again, holding constant wealth, income, age, etc. And what the concept of experience-based learning tries to convey is that this is very unrealistic, that we are missing out a big component of what determines human decision-making. What I will argue is that personal experience affects behavior more strongly than just learned information about outcomes, and it doesn't even matter, as often claimed for some of the behavioral approaches, whether you are a particularly smart, successful individual or not. This experience effect, I will argue, goes through a channel of, if you want, rewiring you. And I'll very concretely talk about your synapses and about the role of emotions later. So this rewiring happens to you even if you're a highly informed expert. If you are a doctor who experiences a certain drug not to work well in a certain patient, and you know about all the studies that say that, well, that can sometimes happen, but still the drug on average has that effect, well, you know those studies, still having personally seen the adverse outcome, will affect your future decision-making in the type of medicine you prescribe. So let me start from the depression babies example, which here in the US is a famous example. The notion being that supposedly people who lived through the Great Depression experienced that worldwide crisis and we're confronted with newspaper headlines such as those: billions lost as stocks crash, Wall Street in panic, etc. Maybe personally lost a lot of money, even if not, lived in a world where that was the news every day, that they are altered, that they are supposedly avoiding the stock market and all things risky like the plague, as in that quote. Now, if you go towards historical economic history books describing that period, in fact, you pick up a notion of economists saying that this event had really long-lasting implications. So, for example, in Friedman and Schwartz's Monetary History of the United States, and these are certainly not behavioral economists, they talk, however, in the introduction about how that event of the Great Depression created a mood of pessimism that for a long time affected markets. So there's some notion of it leaving an impact that might go above and beyond our standard wealth, income, etc. routes. Similarly, for the recent financial crisis, Olivier Blanchard has been arguing repeatedly how this crisis has left deep scars, which will affect supply and demand for many years to come. So again, possibly a notion of something being altered, even if we are able to reestablish the conditions exactly like they were before the financial crisis. Now this, particularly the recent financial crisis, has started to change economists' thinking about how we form beliefs and how we form risk attitudes, even in macro finance. If I had more time, I would talk about there being a long tradition of people thinking about non-standard belief formation and decision theory and microeconomics, also in applied microeconomics. Macro finance, that was the area, that is one of the areas where the rational expectation view is still pretty predominant. Well, at least until the recent financial crisis. All these inconsistencies in how people reacted really strongly, withdrew their market from the stock market, are still acting in much more risk-averse manners than standard models would predict, was maybe part of the reason why a new wave of research took off, which tried to propose alternatives of what happens when we live through some extreme events. Now, a first wave of that literature zoomed in particular on what I'll call recency bias. This idea that, there's a recent event, we react to it and react to it in a manner which seems to be out of proportion to all the other experiences we have had earlier in life, or we've learned about how the stock market works, how asset markets work. And these are models like Foerster-Hibbert-Leibson's natural expectations models, also in a related paper with Mendel, or various papers that use terms like over-extrapolation or over-inference. They picked up on humans being pretty strongly affected by some recent experience they have lived through. But as I try to emphasize in my introduction, that's not the only puzzling aspect. And that's an aspect actually we economists have been pretty well able to model even in standard Bayesian models. It's more this kind of really long-lasting effect, which hasn't gotten a lot of attention in the economic, from the theory perspective, but also in terms of an analysis of empirical data. That a crisis, even the notion that a crisis would alter not only standard economic conditions, but would alter the people who lived through them in a lasting manner. And that's exactly what models of experience-based belief formation are trying to capture. So to give you an overview of the different examples I want to touch on today, I want to speak about the different, mostly financial or finance/macro markets where evidence has been found, mostly from my own research, starting with the stock market, the depression babies example, but also beliefs about inflation, beliefs about interest rates, how that in turn affects the decision to buy versus rent, and conditional on buying your home, how it affects your choice of a fixed rate versus adjustable rate mortgage, also consumption decisions. And like the theme I hope to convey to you in my tour de force through these different applications is that it seems to be a pattern of what people do with their lifetime experiences. And that pattern will pop up as kind of, can't see it so well, like the like the dotted, somewhat steeper than linearly declining function up there, to which I'll go back later. It seems to be the case that things we've experienced in our life gets incorporated, overweight in our beliefs going forward in the future in a manner that puts a lot of weight on what happened recently, the high recent weights, but going back to our birth here, there are lasting effects of everything we've lived through. So interesting, the first kind of big picture result, which I hope will emanate from the little overview I will give, is we seem to act in a very similar manner, following a very similar pattern, whether we look at stock market, inflation beliefs, housing market, consumption decisions. Some extra weight given to things we personally experience compared to things we just read about or learn about in a class or in another written form. And then I want to emphasize that this happens to people even if they are highly successful, highly intelligent professionals, even specialists in the area, FOMC members, when predicting inflation, our core central bankers, when predicting inflations, tend to overweigh their personal inflation experience, is what I'll argue. After that overview, I want to get to the mechanism. How does it work? Why do our personal experience have such an impact on us, even though we know it's just some outcome of some stochastic process we happen to personally live through? And I think the answer to that is the role of emotions, which I know is emphasized here a lot in various lab work. I'll talk about the emotional tagging hypothesis or synaptic tagging and what I hope future research will be able to do with exploiting more positive versus negative emotions and coming up with predictions of how certain events affect us depending on the emotions we felt at the moment. And at the very end, I'll just want to conclude by saying, I'm starting this talk by having this like extreme Homo economicus up there and saying, well, we behavioral economists want to bring in more psychological realism into the way we think about human decision making. But at the same time, this experience-based learning, which is my theme and my big research interest, doesn't really want to contrast like a Homo economicus with a more human decision maker, Homo humanus or sapiens, if we want. So I'm going to use Homo Experiens to contrast, to say this contrast doesn't lead us very far. We just need to better take into account dynamically what shapes us in our decision making. So that will be at the very end. So let me start from the depression babies example. So the idea was to say there's this notion out there that people who have lived through the Great Depression tend to shy away from the stock market above and beyond what standard models suggest. Well, is that true? So to test whether that's true, you need to measure individual investors' stock market experience over their life so far and see whether it helps you to predict whether they are stock market participants, either on the extensive margin, do they invest at all, or also on the intensive margin, how much of their liquid wealth is invested in the stock market. And by the way, you can do the same for other risky asset markets. You can do it for the bond market. You can pick your favorite financial market. If you look at the raw data, there's definitely some pattern that seems to be there. But this, for now, I'm just kind of showing raw time series. So if you plot over time, what fraction of the population, and I'm restricting myself here to people from their mid-30s to their mid-40s to keep things constant, invest at least $1 in the stock market. So we start with the cohort born up to 1920, so pretty low at the time. Then you see some increase for the cohort born 21 to 30, a higher increase 30 to 40, and then a dip down 41 to 50, and so on. So what this graph conveys is that in the raw data, the generation that experienced the 1930s Great Depression as teenagers, young adult, have significantly lower stock market participation than any other cohort, around 13% versus 26 to 32. The increase instead over the next 2 decades of cohorts up to the 1931 to 1940 cohort here is consistent with those being the people who have experienced this post-war boom years during their young adult years and possibly haven't gotten a more positive attitude towards the stock market. And then you see again that the 1941 to 1950 cohort, well, dips again in the rate. So it's not just an increasing time trend. No, no, these scores will go down again in their willingness to invest in the stock market, consistent with the fact that this cohort reached the mid-30s to 40s just after the depression years, oil crisis, etc. of the 1970s. So the question is that just kind of a pattern we see in the raw data, or can we really distinguish it from other explanations, like age confounds, wealth confounds, time effects, etc.? How can you test that? So the solution, Stefan Nagel from Michigan and I chose to try and to address is to get as long as possible a time series of data on stock market fluctuations and individual investment. There's a survey of consumer finances that many financial economists use. It has also, that mostly started in the 80s, but it has a predecessor, which you can get through the University of Michigan, which basically records asset holdings and demographics starting in 1947. And this data is wonderful in that it gives you not only lots of financial information, but also has lots of demographic information, age, ethnicity, education, marriage status, etc., some proxies for wealth, income, and so you're able to control for a lot of these other factors. So the idea, sorry about that, the idea of how we're going to generate evidence here that distinguishes that experience have a lasting impact from age determinants is maybe best conveyed with an example. So if you look at the early 1980s, you will see that then young households had a relatively low stock market participation, and conditional on investing at all, they invested a relatively low fraction of their liquid wealth into stocks, and also in surveys report higher risk aversion than older households. So you can do, for example, below 40, above 60, or below 35, above 65 to kind of group, or you can just split the population. And so that's interesting. It's also consistent with then young households having pretty much experienced nothing but the relatively low stock returns of the 1970s, while the older households have experienced not only the 1970s, they've seen also that in the 1950s and 1960s, the returns were relatively high. So that's consistent with them not being as averse to stock market investment. But it's not a young versus old pattern. If you look at the 1990s, it flips. And that's key to how we kind of tease out these effects. The then young households had actually higher rates of stock market participation, higher allocation of their liquid assets to stocks, and reported lower risk aversion than older households. Meaning that, again, it's consistent with their lifetime experience, but this time flipped. So young households experienced the 1990s boom years and hence had pretty much seen only good outcomes from stock market investment in their lifetime so far. So what I'm trying to convey with that example is if you're interested in how experiences may shape you and you want to distinguish it from just time effects, these were the boom years, these were the bust years, and you want to distinguish it from age effects, young people invest differently from older generation, well, you want to then exploit that there are correlated changes in what happens in the market, and therefore in terms of returns generated by the market, and the age profile of what people have experienced, whether older generation have seen better things in their life or worse things in their lives than on average than younger generations. So it's correlated changes in the age profile of average returns, lifetime average returns, and the risk taking. So what did we find? I will not show you the exact estimation tables. You can look those up in my papers. But let me just kind of give you the headline for the three types of results. If we just start from what people answer to a survey, where you ask people, how willing are you to take risk? And you give them four options. You say either one, well, I'm very conservative. I'm not willing to take any financial risk. Or two, I'm willing to take average financial risk, expecting to earn average returns. Or three, I'm willing to take above average financial risk, expecting above average returns. Or finally, four, I'm willing to take substantial financial risk, but also hoping for substantial returns. Well, for starters, a lot of people put themselves in the very conservative group, 36.3% in the lowest risk tolerance group. But if I now compare people who have had, just given the year they were born and the age they currently have seen in their life so far just pretty crappy returns. Let's say they're at the 10th percentile of lifetime experience returns. And I'll compare such a person to one at the 90th percentile. So that person was lucky. In her lifetime so far, returns have been pretty good, so she's mostly seen good outcomes. And then I asked, is that correlated with how risk-averse they describe themselves? The answer is yes. So that so-called interdecile range from the 10th to 90th percentile comes with a shift of minus 10 percentage points in your inclination to put yourself in this very risk-averse category. So out of a baseline of 36.3%, about a third disappear if I just give them substantially better lifetime experiences. And that's not only what they say in the survey, that's actually what they do in their investment behavior. So for the time period for which we have data, we have a stock market participation around 35% on average, direct and indirect, meaning people who invest at least $1 in the stock market. If I again compare a person with a pretty crappy experience, 10th percentile, to one with really good experience, if I do that same interdecile range comparison, I get an increase of 14 percentage points. So a third to a half of increase in terms of willingness to invest in the stock market. And finally, same holds actually for bond market experiences and bond market investment. So there we also have a participation rate of around 35% in that period for that data. And the interdecile range change in experience implies a 15 percentage points increase. So really large effects. Now, while the main paper research project was about the individual investment decisions, it's kind of interesting to do a back of the envelope calculation where you ask yourself, could that actually explain whole market movements, what happens in markets? Can we aggregate that up? So here's our back of the envelope calculation. We said, well, given the estimates we come up in the paper, namely that people overweigh their personal experiences with weights that are kind of roughly linearly declining, a little steeper. So recent experiences really affect me, but even stuff early in my childhood, young adulthood still matters. I put some significant weight on it. Let's say everybody does that. Then we go to the US Census and basically get all the whole US population, let's say maybe between 25 and 75, to have a common constraint on the investors you're considering, but you can also go broader. And we say, okay, give me the birth year of that person in that year I'm looking at, starting in 1946 and going up to recent years. And now let's just calculate for that person her lifetime average stock market experience up to that year I'm currently looking at. And I'm just going to take the S&P 500, right? I don't know exactly how much each person has invested in the stock market. So I calculate that person's lifetime experience with the stock market just from birth to today. And then I average it over the whole US population. I do that with some weights which account for liquidity of the households, but even that doesn't matter too much. And so I get, in red, the average experience of stock market returns in the US population. These are the bars over time. And then I plot against that the price-earnings ratio of the US stock market. So price earnings, at what price a stock is traded relative to the earnings it produces. And we know from Schiller that this is a good predictor of currently high valuation in the market, likely future downturn. So that's what I plotted in blue on the scale shown there on the right. And you don't need to do a lot of econometrics to see that those two are highly correlated. So while this is not an experiment, a randomized controlled trial type analysis, it seems that the experience of everybody alive and potentially trading in the stock market at a given point in time has a lot to do with how highly or low valued stocks are on average in the whole economy. So there's a good chance that this adds up and explains to a significant extent what happens to aggregate macrofinance variables, is what we're saying with this graph. Just to kind of clarify the little picture at the first intro slide, when we were doing these estimations, we were not making any presumptions on to what extent people weigh different experience over the course of their life. We said maybe early experiences matter most, or maybe it's equally weighted, or we tried a bunch of different also functional forms. And what comes out in all these estimations, I mean, for now I've just talked about bond and stock market, is this dotted black line. Lambda is a parameter we're using, which says basically, if I take here a hypothetical 50-year-old person, and I go from, well, let me use this one here, it's maybe easier. I go from today back to the birth year, 50 years back, then how does that person weigh her lifetime experiences? Well, it pretty much takes all that she has seen over life so far, weighs them with these weights, a lot of weight to what happened recently, maybe a relatively recent financial crisis or so is still in there, less stuff early on, but if it was only big enough, if you're looking at somebody in the 1960s and ask, does the Great Depression still matter? Yeah, the answer is yes. Even if the weight is not as big as the weight I put on today's data, I personally experience the size of the outcome will have the effect that it affects significantly my willingness to take risk. So that's the weighting function that comes out of trying to estimate simultaneously, do experiences matter and how do they matter in the stock and bond market? And the exact same weights will turn out to also explain consumption behavior, inflation expectation, mortgage choices, etc. I won't repeat it there, but that's one of the interesting facts we came across while working on many different papers, that there seems to be a certain pattern on how humans incorporate their lifetime experiences. Let me go from the stock market now to inflation. That's actually the first topic Stefan Nagel and I were interested in. We were both at Stanford at the time and talking the hallway about why Germans are so obsessed with inflation and highly suspicious of, then Mario Draghi running the ECB. I don't know whether they're less suspicious of Lagarde now, but kind of thinking, well, these people don't understand how terrible inflation can be. And a notion often proposed is that this aversion of Germans, or the suspicion about inflation creeping in, comes from the years of the German hyperinflation. Like, these are pictures every German has seen in the textbooks and history lessons going through middle school and college. I won't actually quite be able to explain the Germans, why it still matters so much. I actually have nothing to say about, but that was the original motivation. So the question here is, do lifetime experiences of inflation I have seen, price increases creeping up over my life so far, have explanatory power when I'll be asked today, what do you think inflation will be next year? And a lot of central bankers have voiced that suspicion. So for example, if you go back to the 1980s, 1970s, 1980s, when we had this spike in inflation here in the US, which Paul Volcker was trying to combat, the one hurdle, like what he described as his biggest problem, was that, as he said, an entire generation of young adults has grown up since the mid-1960s knowing only inflation, nothing but inflation. And as a result, he's asking himself, well, will I ever be able to convince them? It is hardly surprising that many citizens have begun to wonder whether it's realistic to anticipate a return to general price stability. So what he's kind of trying to express is, even if we implement reasonable measures, which according to monetary theories should help us combat inflation, will I fail to convince people because they're really shaped by what they have seen in their life so far? And also Ben Bernanke, when running the Fed and steering it through the more recent financial crisis, he talked about the difficulty of credibly conveying to the public what they're doing and what the effects will be, and his frustration with being able to convince the public. So let me just show you in one picture kind of the results you get when you try to explain people's inflation belief with the model of experience-based learning. So what I'm plotting here is, in a somewhat special way, which I need to explain, I'm plotting here the answer people give to the question of what do you think inflation will be over the next year? Will price go up, down, or stay the same? And if they go up or down, by how much? And that's asked in the Michigan Survey of Consumers, which we're using here. And I'm grouping the answers people give to that question in two ways. First of all, I'm bunching together everybody below 40. These are the black diamonds, and above 60, the blue dots, and the red little X's are people in the middle, 40 to 60. And then I'm actually not plotting the actual answer, but I'm plotting the deviation from the cross-sectional mean. So as you can imagine, the answers to that question went up a lot in around 1980 when inflation was going up. So I'm taking out the average. I'm just interested in how younger and older generations deviate from the mean. And you can see that early on, you know, maybe below 40, the young generation was more pessimistic, then they dipped a little bit below the older generation. Then during the oil crisis in 1980, high inflation in the US, it was particularly the young who were strongly affected by that. And in later years, it reversed again. How can we explain that? Well, many macro models don't even try to explain it. We typically just calculate the average and try to fit the data to the mean. And I'm saying we're foregoing a big opportunity here because the differences are huge. 1980, you have a difference of about 2.5 percentage points between what the above 60 and below 40 believe. That's important. We want to understand that, in particular, given that the above 60 are the ones who have means and might be investing the money, and the below 40 are the ones who might want to borrow, and it will influence how financial markets work. So what happens if you fit a model of experience-based belief formation? Now, inflation is an AR1 process or something close to an AR1 process, so I can't just take simple averages. But in terms of conveying the intuition, let's think about it that way. Let's think about it the same way we thought about depression babies. I check for every person who gave an answer to that question, what is her birth year? Then I calculate, roughly speaking, the lifetime average inflation of that person with linearly declining weights, or the AR1 process equivalent of that. And then I plot what that person would therefore believe, of course still controlling for time effects and for any other controls the data is willing to give me. And what comes out of that calculation are these solid and dashed lines. You see again in the same colors, black, red, and blue. So you see that experience-based inflation is able to, or experience-based inflation model is able to predict that early on the young are more pessimistic, it switches, then we have these two spikes of the young being particularly different in their opinion from older generations, being particularly influenced by having seen nothing but inflation, as Volcker was saying, and then later converging more and even reversing. It is not perfect, you know, the difference of 2.5 percentage point, we can't quite explain that. We only get up to like 2 percentage points, a little less than that, but it's progress, right? So far we've ignored that there's humongous heterogeneity in people's beliefs about these financial macro variables. And if we just look back at what they've seen in their lives so far, we're able to predict and explain a big chunk of it, is what this graph is trying to convey. Moreover, while the Michigan Survey of Consumers is a survey, you know, sent to questions asked to consumers, like it's supposed to be representative of the US population, I do want to highlight, as I did in the beginning, that nobody is immune to these type of effects, that even people who are experts and know a lot about inflation are affected by what they've seen personally in their life. My favorite example is a German guy, originally German guy, born as Heinrich Wallich in Berlin, grew up in a family of bankers in 1914, lived through Germany's hyperinflation in 1923, then emigrated to the US in the 1930s, became Henry Wallich, I guess that's how it's pronounced, and was ultimately a Fed governor 1974 to 1986. Well, this guy who had experienced the German hyperinflation still holds the records in how much he dissented in the hawkish direction when they were on the FOMC, the Federal Open Market Committee, are voting on do they raise interest rates or not, who kept preaching, I mean, his wonderful quotes about how people don't understand how easily inflation will creep in and how we have to fight back to keep the economy working. Now, this is a very smart man, also an academic, who certainly understands he's not in Berlin anymore, he's in the US. It's not 1923 anymore, we're in the 70s and 80s. And as far as I understand, in front of him on his desk are a long time series of data about inflation and all possible information you would want, right? Despite this fact, despite the fact that we really can't torture the information asymmetry kind of models to try to explain that, you find that decades later he seems to be affected by these past experiences in his voting behavior. Now, while here's my favorite example, this is more general. So we did in a paper with Stefan Nagel and Zach Yan, we collected all the voting decisions of the FOMC since the reestablished Fed independence in 1951 and looked at who dissents right? So the way it works at their meetings, the chairperson proposes what they're going to do, and then people either say they agree or they dissent, and it might be in a hawkish direction or it might be in a dovish direction. And, dissents are relatively rare. It's not that the vast majority dissents, particularly in recent years, but what is interesting to me is that personal lifetime experience, inflation you have seen in your life so far, seems to have significant predictive power. So on the left, in blue, I have the probabilities of dovish dissent, people saying, no, we have to worry less about inflation, we should support employment more. That is about 2.5% on average in our data. If I increase your lifetime experience of experience-based inflation just a little bit by 0.1 percentage points, which is kind of a within-group standard deviation. I mean, these people on the FOMC are overall, of course, pretty similar. They're typically male and somewhat older and so on. So I don't have as much variation to work with as in the Michigan survey, but still, like there's some variation, 0.1 percentage points in lifetime experience. That has a visible impact. So the probability of a dovish dissent goes down by about 1/4 to 1/3. And then vice versa, if I look at the probability of a hawkish dissent, which is somewhere around 4% on average, well, that increases by about 1/4 to 1/3 if I just increase your lifetime exposure to inflation by 0.1 percentage points. So it doesn't only hold for Henry Wallach. In fact, Henry Wallach, I can't even fit him in my model. Like, I don't know how to fit my model breaks if I try to put in the German hyperinflation. But for everybody else, I find exactly the same effect. Another way to look at it is the following. Our central bankers are twice a year asked to give a forecast to Congress about their beliefs about future inflation and some other variables. So in these semi-annual forecasts, that's under certain conditions, under the ideal economic policy being implemented, so there's some caveats to it, but roughly speaking, one of the questions persistently being asked is what will be inflation over the next year? Now, the interesting thing is, which actually my colleagues David and Christy Roma have written a nice paper about, is that before they go in and record their opinion, their staff actually works really hard and produces these green books in which they tell the central bankers, the FOMC members, what they think they should answer, what the models the Fed is using would tell you inflation will be next year. And when the FOMC members themselves then state their opinion, they tend to deviate from what their staff told them, and they tend to make it worse. So what Roma and Roma found is if they were only listening to their staff, they would be making better inflation forecasts than when they deviate and come up with their own opinion. So that's actually a really cool paper. Now what we do here is to say, well, can we maybe explain why they do that? And the answer is yes. So on the left-hand side of this axis, I show the forecast the FOMC member gives to Congress, normalizing, differentiating out the staff forecast. And on the horizontal axis, I show the experience-based inflation forecast. Basically what the experience-based learning model gives you predicts they will think inflation will be next year. Again, differentiating out the staff forecast. And you see a cloud of dots here, but I hope that even without me running the regression, you can see there's a very strong positive correlation. The higher my personal lifetime experience has been in terms of inflation I've personally been exposed to when buying milk or buying a car or buying a house so far, significantly affects my inclination to deviate from what the Fed model says I should say and say, no, I understand, but you guys, I have a feeling it will be somewhat higher, given what I've seen so far. So highly professional people can't stop themselves from being influenced by their personal experiences. Now, the one other version of it, which I couldn't resist showing here, comes from a talk I recently gave at the so-called Secular Forum, which PIMCO, the bond trading financial company, holds once a year. And so before I was giving my talk there, I was allowed to run a survey with the people working at PIMCO. So again, experts really think about inflation and interest rates all day long. And I mean, they're running that baseline survey anyhow, where they ask their employees the following question: the IMF forecasts advanced economy inflation to average 2% over our secular horizon. do you think that advanced economy inflation will be higher than that forecast, approximately equal or lower? And so I wanted to know people's answers, but I also wanted to know their birth year, and you can guess already why. And in this case, I also wanted to know which country they are from. So most people are Americans, but it's actually quite a chunk of Germans. Maybe they were overrepresented in my survey. They did it because the German was asking, not sure. Then I had a bunch of UK, Japan, Italy, and then it was smaller and smaller. So US and Germany were the biggest groups. So I zoomed into that and plotted here for every person in the German or in the US, in my two main groups, like their lifetime average inflation experience. And you see that that has actually been higher if I average within nationality and within nation for the Americans and the Germans over their lifetime so far. So just the people who are currently working there. And then I said, well, how is that reflected in any way in the answers they gave? And the answer is yes. So in terms of percentage who said, well, the IMF thinks it's 2%, but I think it will be higher, it was indeed 10 percentage point higher, 41% who said it among the Americans than among the Germans. So again, this is of course not the causal proof, but it's really interesting to see that even at this company, they're all sitting in US offices, or well, not only US, but they're all working for the same company, working with the same data, being asked about advanced economy inflation, not your local inflation, or if you're sitting still in your home country. And again, most of them are in the US. You see that what they've seen in their lives so far influenced the answer to that question. And these are the best and the smartest people kind of working in these markets. So far, we've seen that it seems to be the case that if I try to understand, to predict people's beliefs about how some financial macro variable will move in the future, I can look at that person's life so far, see what were their experiences so far, and I get significant predictive power, economically large and statistically significant, that had been ignored in previous models. Now, this translates in some of the most important financial decisions people make over their lifetime. So let me go to the home ownership decision, which has been in the press a lot recently, kind of ever since the financial crisis, but like very recently, just over the last week, there are a couple of Wall Street Journal and other articles, and here I'm citing some earlier ones, where people have remarked on the fact that, sure, the housing crisis wasn't great in terms of supporting home ownership, but now, 10 years plus later, for some reason, we are still seeing much lower rates of people buying their own home at an age they used to do it, compared to how it was before the crisis, even if we control for their means, for their wealth, for their income, for their employment situation. So as the Gen Xers enter the typical first-time homebuyer age, entered it originally, that was just the time when the pre-crisis peak was observed in the real estate market. They got completely burnt by it, and now, for whatever reasons, we live in a world where about 3 million people, which we used to predict would become homeowners, are actually renters in their 30s and 40s. Now, you can see what direction my argument will be going. So what I hope policymakers will start to take into account is that we shouldn't just look at how good of an investment is buying your own home. What are the conditions under which you can borrow? Currently pretty good, given the interest rates. What are the financial criteria the bank will want to see in loan-to-value ratio, et cetera, et cetera. I mean, all of that is important. Public subsidization is important. How the market structures is important. But we shouldn't forget what people have seen in their lives so far happening in the real estate market. Before the crisis, they've just seen it go up and up and up, and seem to have ignored that it could possibly go down again. And now, however, particularly the generation who would become first-time homeowners has very vivid memories of that housing crisis. Here is a cross-country way to show you the same message. So if I look at housing markets across different countries, and let me just zoom into Europe for a second, mostly because the ECB runs such a nice household finance and consumption survey. It is interesting to see how much different countries in Europe vary in people's inclination to buy the home in which they live. So in Germany, Austria, we're somewhere at the lower end, 45, 50%, France also pretty low. And then at the other end of the spectrum, Spain, Slovakia, you're somewhere in the high 80s and 90s, meaning that, say, in Slovakia, 90% of people live in a home they own, or they bought. Maybe the bank still owns it, but they bought their own home. For comparison, I've thrown in United States, they're around 67%, roughly in the middle. Now, my argument in this case, together with Alexander Steiny, one of our PhD students in Berkeley, is while a lot of these differences are of course explained by differences in subsidization of mortgages, mortgage market structure, etc., etc., it does not explain, these factors do not explain everything. And if you look back at the history of inflation these people in these countries have lived through, you get an idea that this may have a significant influence. So in the paper, we run individual level regressions, controlling for all sorts of factors, but let me show you just a picture of some aggregate numbers right now. Here on the left, I have a picture where I show the top quartile of home ownership rates across Europe. So the countries where home ownership is largest, and show the inflation rate since actually 1925 in those countries. On the right, I show the inflation rates for the bottom quartile of lowest home ownership rate countries, France, Austria, Germany. And what is interesting to me is that while around World War II, of course, there was a lot of inflation issues, valuation issues, if you look back at the last 40 years, you know, those times, 30, 40 years, which people who might be buying their first home now have experienced, you see significantly higher inflation rates in the countries where people buy a home as soon as possible, as soon as they have money, they feel they need to invest it in real estate, versus the countries where people are more comfortable renting. So where I'm going with this argument is it seems to be the case, also from surveys in terms of beliefs and reasons to invest in home ownership, that people who have lived through high inflation are really worried about the value of their money, hence think real estate is a good investment opportunity, in particular if it's financed with a fixed rate mortgage. Why? Well, a fixed rate mortgage, I'm basically promised the interest rate today. Me, having lived through high inflation, expect future nominal rates to keep increasing. I think everybody underestimates. So I think fixed rates are a really good deal. I tend to choose fixed rates over variable rates too much, something that's very prevalent, unfortunately, in the US. We have a separate paper on that with Matthew Bodge. And then as a result, the housing market looks very different. People like to individually buy their own home instead of renting. Now, these are some of the markets which are affected by experience-based learning. So kind of so far, I've told you that if you're trying to predict willingness to take risk in different markets and beliefs about outcomes of these risky variables like stock market returns, bond returns, inflation, etc., well, we have to look back at people's life, what they've seen so far. And even though they might know that's not the full data, I've been taught in grad school what the full data is. I know the numbers, they put a lot of weight on stuff they've personally experienced. Now, however, how exactly that works is still a little bit more unclear. The proxy for a good or bad experience is sometimes a little unclear. You know, it worked pretty well in the examples I gave you today. You know, good experience in the stock market probably means high returns, and then I can look at your willingness to invest in the stock market. If I look at consumption choices, am I a person who's a very cautious consumer, or I'm more freely spending my money? It's already harder to think about what's the experience. Unemployment, how the economy did overall, how the local business is doing. Sometimes it's not as straightforward as in my hand-selected examples here, like what the best proxy is. And also, what is the mechanism? Could it even be the case that sometimes the same experience, the same event might be a good experience for one person and a bad experience for the other person? That would be really interesting if we code that and then find different effects. So the mechanism, we think, explains experience-based learning, relates very strongly to emotions. In the neuroscience literature, there are a lot of papers since the early 2000s about the synaptic tagging hypothesis or emotional tagging hypothesis, which claims the following, that as we're going through certain experiences, and if these experiences are lived through with strong emotions, basically our synapses, are working hard, and we are kind of rewiring the hardware of our brain, roughly speaking. So there's a famous Dolan science paper from 2002 and a Nature paper, Laban and Cabeza, and lots of later literature as well. And so what Christine Laudenbach, Alexander Niesen-Rünzi, and I have been trying to write up in an AA Papers and Proceedings paper is that it seems to be much more important than previously understood in economics that emotions matter in terms of how strongly a certain outcome is encoded, how easy it is for us to get back to that information we've personally experienced, and therefore how much it gets overweighted, how strong our memory is, how quickly we pay attention to it. Emotional events seem to attain privileged status in memory, and if there were positive emotions, generate a positive attitude. If there were negative emotions, generate a negative attitude. So I've heard a lot today about the exciting emotions-based work going on in the laboratory here. Now, I don't have such laboratory data, which would certainly be kind of the cleanest way to go about this. But I'm also interested in more longer-term horizons, which is why I want to present as kind of a last set of results here, data we collected on East versus West Germans. One puzzle that has been Germans have been wrestling with is the questions why 30 years after reunification, East and West Germans are still so different. There's a lot of coverage here in the US actually when we had the equinox of the wall having been down as many years as it has been up, and people talking about, East Germans talking about, well, we marched against the system, we really want it down, but still it leaves an impact on you, it shapes you. And that impact can be seen again in the financial market. So in red, I'm plotting the stock market participation of East Germans. If I add the blue, you get to the stock market participation of the West Germans. It's about a half to a third higher. I mean, it's overall pretty miserable. Don't read the axis, the units on the axis. So that's a bigger problem the Germans have to solve. But like there's this persistent difference between East and West Germans. And now, well, of course that correlates with experience. In the West, we had the German exchange in Frankfurt reopened shortly after World War II under the American protectorate. In the East, we had a socialist system, no stock market. But there are additional differences, not only the gap, which is amazingly persistent in stock market participation. It is interesting to see that, there's a lot of propaganda against the US, army go home, pro-Soviet Union, pro-Vietnam, pro-other socialist brother countries. It's interesting to see that the differences are strongest if you zoom into either the financial industry, if you zoom into US companies, which Germans tend to invest to, like the big names, Microsoft, General Electric, General Motors. That's when the East Germans are particularly averse. And it reverts. It's the opposite. If instead I look at companies who are traded, where shares are traded in Germany or Germans invest in, which belong to Chinese, Russian, or Vietnamese companies. So it's typically oil, telecom. There's a brewery in China Germans love and invest in. And there it's the East Germans who invest particularly much. And more generally speaking, state-owned companies or formerly state-owned companies, whether German or foreign, tend to get a higher rate of investment by East Germans than West Germans. So where I'm going with that is it seems that this experience of having lived in East Germany and being exposed to the propaganda has a lasting impact. And now I can show you my mini attempt to get at positive versus negative emotions. If I zoom, so for this paper, we have one of the largest data sets existing from an online brokerage and various data sets from a bank on investment, and we know the location of people, lots of information about them. If I zoom into the investment behavior of people who had a relatively good experience living in the GDR, in East Germany before the wall came down, you can try to find a couple of different proxies. So one is, for example, sports was really big. So not only the one time the East German soccer team beat the West German soccer team was advertised a lot, like Olympic medal winning was really important, Olympic champions were celebrated, so on. If you grow up in one of these areas with lots of celebration and pride, you are still particularly anti-capital markets, anti-stock market today. If you lived in one of the GDR's showcase cities, so cities that got renamed, for example, from Chemnitz into Karl-Marx-Stadt or other communist names, and that came along with lots of city celebrations, lots of attention, extra spending, etc., you really soaked up the anti-capital markets attitudes. You're still particularly unlikely to invest in the stock market today. If instead I go into areas where people had pretty bad experiences, so a huge problem in the East was air pollution, sulfur dioxide. Here's a map of where it was particularly bad. So much that in these highly affected areas, almost every second child had significant respiratory diseases. If you grew up in one of those areas where, despite the GDR claiming that they're pro-environment and want to protect it, you suffered really strong consequences, your kid did, well, you are embracing capital markets today. You have a higher stock market participation. Another one, a religious area, so it's mostly Catholic and Protestant. Religious life was suppressed, religion, opium for the people, of the people. Now, these people also didn't like so much living under the GDR, higher stock market participation today. They are embracing capital markets. They had a negative experience with that attitude towards investment and towards markets and embracing the new one. And then the last one, a famous one, actually the closest to a natural experiment is, it's a little tricky, but let me quickly explain it, access to TV entertainment. So people in the East didn't have as good TV entertainment, like the German version of CSI Crime or whatever you want to watch in the evening, and like to watch it on Western TV. Western TV could be, this is a map of East Germany, so there's Berlin, there was a TV tower there, so the further you are away, kind of circular from that, the less reception you had, and also the further you were away from the West. And people have previously exploited slight variations, you're behind a hill or not, to look at things like brand awareness of Western brands, etc. Now, the political scientists have found something really interesting. I thought originally if you have access to Western TV, you become more pro-Western. But that's only the case for access to, the more propaganda, the more, politically engaged messages that came from, American-supported radio and TV waves. The standard TV, what happened is people pretty much just wanted to watch these entertainment shows. They had, a safe workplace, no unemployment, they would come home, not too many, interesting food or other things to buy, but at least you could watch some good TV, go to bed and be happy. In areas like these dark ones around Dresden here, the so-called Valley of the Clunes, and up here, but around Eisenach, these areas where there was less access to TV, where the areas where people were really unhappy, highest rate of people trying to flee the country, to escape, to apply, to get an exception, to get to the West. So Western TV was basically used for entertainment. If you didn't have it, you became very unhappy with living in the East. So that's surprising. There's a whole big political science literature by several researchers at MIT and Princeton about that. But what I want to zoom in here is, does that also translate with unhappiness about the financial system? And it does. So it was maybe a little bit counterintuitive initially, but if you're one of the people who didn't even have TV, you are particularly unhappy, Western TV, and you embrace the stock market more. So takeaways from all of these examples is that I hope to kind of give you a glimpse into this emerging literature that says daily exposure to outcomes of all sorts of variables in the macro finance field in particular gets aggregated over your lifetime and influences you for the long run. It shapes who you are. And as a result, we can't quite think that once a crisis is over or economic conditions have changed, if we only reestablish the wealth and income and employment conditions we had before, people will act the same way they did before. They're altered. They will be influenced that in the long run, even if they're experts and have correct assessment and training about stochastic processes and outcomes. Even in firms, there's some institutional memory that builds up which I'm looking at in a project of banks. Now, as an empirical wish, I hope, of course, that we can get better data on lifetime experiences and kind of show this in more applications going forward. Let me finish with going back to my initial little graph about this Homo economicus, where I said, well, neoclassical economics said, dollars, we maximize payoffs, we rationally form beliefs, we have perfect condition. And then behavioral economists came along and said, well, that's all not true. Things like morals and honor influence us, not only money. We might not always form rational beliefs. We might be somewhat overconfident in assessing the power of our pawn here. And we might not have perfect ability to process all the information thrown at us. So behavioral economists said it's like we need a more human Homo. Whether Homo sapiens is the right word, like the wise Homo, I'm not so sure, but we want to introduce some psychological realism. Now, what I'm trying to say here is sometimes I feel we're wasting a little bit our time in contrasting these two. I want to also introduce some kind of dynamic realism, to think about humans. They're born with certain preferences, beliefs, and certain cognition, and then they walk through life, things happen to them, and that alters them, and that will help us to better predict their future risk attitudes, their future behavior and choices. So it's kind of interesting. So I use Homo experience, experiere to experience, and experience while you're experiencing. In fact, the word expert, I'm emphasizing today that even experts are subject to experience-based learning. Well, no surprise, the same word, like you have had experience. So what I hope you can walk away with is that you walk either like through something, you come out of it, you're a different person, and whether that's one of the classic economic variables like risk attitude, or more behavioral like loss aversion, or non-standard forms of discounting which are affected, doesn't matter so much to me. I just want for us to take into account what kind of personal lifetime experience you're dealing with. So that's the conclusion. Personal lifetime experience have a strong predictive power, even among experts. It's not a question of intelligence, it's a question of being human and making experiences. If you want to deal with that on the theory side, you actually don't have to go very far. You can use a quasi-Bayesian framework, just restricted to lifetime experiences or overweighting it. And I think there's a lot of power to explore this both experimentally and in terms of getting access to better and better big data sets, allowing us to ultimately generate higher welfare and surplus and also profits. Thank you very much.
Fantastic talk. Thank you so much. My name is Ulrike Malmendier. I should start by saying that I'm interested in emotions as well. I study emotions in privacy decision making, but I'm also in an MIS department, so I trust information systems a lot. So I tend to believe that in the future we will leave a lot more decisions to machines than to humans. And I find myself asking myself this question: why am I even studying emotions if 20 years from now, nobody will ever make decisions themselves? They will just let machines and artificial intelligence take decisions for them. So what do you how would you answer a question like that?
This is an excellent question. One I'm also thinking about, not in my research, but really fascinating. Now, let me distinguish between these, I had these stylized three areas of aspects we take into account in human decision making. So payoff maxima, that was about preferences, the next one was about beliefs, and the third one was about cognition. How am I adding up all the data? So the machines will be very helpful to accumulate the data the correct way, rather than like having limited attention, forgetting certain aspects. They might also help us to credibly predict, okay, future stock market returns will have this distribution, not this very left-shifted one, which you just think right now, given their recent experience with the crisis. But, I mean, at least to the extent that the machines are not running the world, but are still like employed to do what we want them to do, so whether it's a decision about, my health, about my financial investment, etc. Well, it will still be up to me to say how much risk I'm willing to take. Right? So like if I think about it in a preference realm for a second, right? I might be a very risk-loving person, I might be a very risk-averse person, and the machine I employ to help me to find my optimal investment, hopefully will implement what I tell the machine to do. So what I'm saying is that if you've lived, say, through the Great Depression, you will be very risk-averse. You will tell your machine, find the best bonds for me to trade in, and you will still therefore see the impact on the outcomes, on the returns you earn, on the measures you take for your health, etc. So that's one aspect. Now, admittedly, I was sneaking into like preferences here, and a lot of my talk was emphasizing that, interestingly, it's like your beliefs which are affected a lot. Here, I'm not so sure like what answer to give you, but I want to share one thing with you, which is, or one aspect I'm thinking about, which is, so I'm kind of saying, if I ask you to predict how the stock market will perform tomorrow, what you have happened to see in your life so far will get overweighted. So while I'm mostly trying to shy away from saying that's a mistake or not, in terms of the beliefs, we can kind of say you might be making a mistake. So we can check ex post. So the machine should really help you to come to the better answer. Now, if you go to this extreme version you just outlined, say, well, we'll be the machine anyhow, I won't even be thinking about my beliefs, then yes, you're right, so maybe don't worry so much. I think, however, a lot of time might be spent on a middle ground, where I will try, so I'm a bank, customer comes in, I say, how much do you invest in stock versus bonds, how risk averse are you? And they say, oh, very risk averse, I saw the financial crisis, I hate any of that. And then you're trying to say, well, okay, if that's your preferences, we're happy to serve you with the following investment options, but you might also be tempted to say, think about it, maybe you're a little too negative, and you may actually want to convince the human of the human being overweighing their personal experience. And that's a really interesting question, how to do that. Again, in your extreme world where the machine is running things, it may not matter, but maybe it would matter. Maybe I would want to convince people to, for example, take up more insurance for certain things or less insurance and convince them that their beliefs are wrong. And how to do that, I think, is unsolved. You know, I think banks are doing the wrong thing or financial institutions are doing the wrong things and just let's categorizing you as risk tolerant or risk loving, that's the end of the story. I feel we need something like a simulated, gamified environment to get people to kind of like the lab. Everybody needs to come to the bank lab and play the investment game for a little bit to kind of undo this experience. At least one thing I'm working on. And I think these kind of results can still be useful in helping people to correct beliefs when the traditional measures we economists have worked on for so long, increase literacy, tell them how to compound interest, tell them how to diversify, they just have so much less of an effect than we hoped. And I think the answer is we need to give them experiences that simulate it. So that's the partial answer I have on beliefs.
Okay, I'm going to assert people don't use proper logic for their risk return. We don't teach it in grade schools or at university level, just basic common knowledge. I know, okay, if I look at history over any 20-year period, I can earn 10% on the US stock market, the S&P 500. I know my house, over any 20-year period or whatever, I'm going to earn 3% on average. And I know that's what inflation is going to be. I know bonds are going to perform that well. So given that fact, I don't need automation, I don't need a big education to do all that. All I need is to know the basics, and then I can make my choices. And when the stock market goes down, I actually should be, if I was smart enough, but I don't think I am. I should invest more. And when it goes up, I should invest less. But I don't need to be a smart guy, and I can beat 95% of the so-called experts. I look at a guy like Ben Franklin, who talked about compound interest, penny saved and a penny earned. This is all his time. The methods, and I think we kind of make it too complicated. But when we're talking about the German experience, I think taxes can have a positive or negative impact, and whether you have individual responsibility, when I say group, I mean either a union that's responsible for your life decision-making, or a government, or a company responsible for your life choices. That can be a big impact. But anyway, I just think it's simple.
Was there a question? But then, but like maybe one comment to what you just said. In some sense, the view that it's simple, right? You don't need to contrast the behavioral view with the standard neoclassical view. We would all agree, like, right? Thaler and Farmer at the two ends of the spectrum would all agree, just invest in a broadly diversified way in the stock market with the lowest possible fee. Don't do any picking, don't have these miserable German, stock market participation rate. Everybody agrees on that. Why is that not happening? That's exactly kind of my starting point. Now, I can't exactly explain why it's so low on average and all the cross-country difference, but I can explain a good piece of it, which is that past experiences of some bad outcomes have this lasting memory, this lasting impact on generations of investors who keep shying away from it. And there are a couple of papers also by other researchers who say if a stock market was once affected by corruption or some manipulation of the prices, it doesn't suffice that problem is fixed, like credibly fixed. That's great that it's credibly fixed and we can now invest in the stock market without worrying. No, that stays with you, that lingering suspicion. And so that's exactly what I'm saying. I can give a little bit of an answer why people, even though it's so easy as you pointed out, are not doing it. And possibly there was a previous answer, one could use maybe that concept that people need good experiences to open up to what should be obvious, to help them to get there. Maybe that could actually be used to fix the situation.
Okay, so you look at lifetime experience, and I'm wondering if you've ever gone more years back to maybe look at if people are learning from their parents' experience as well.
Yeah, no, that's a very good question. And by the way, for completeness, you could have also asked me the opposite question. You could say, Ulrike, really? You start at birth? Were you reading the Wall Street Journal when you're born? Are you sure? Should we start a little later? And so, mathematically speaking, what happens in the kind of results I showed you today is basically, if I take your whole lifetime, I put a little bit weight on everything, given that it's relatively little in the beginning, it doesn't matter so much if I start a little later and kind of squeeze my function a bit and the weights go a little up, or I start earlier. So the good news is the result is pretty robust to maybe starting earlier or later. The bad news is, you came, of course, not from just mathematical reasons to that question, but because your intuition is, well, your parents leave an impact on you. For sure, my parents, seeing them worry about oil prices a lot makes me still drive to a gas station far away, and because the price is a cent lower or something like that. And so I'm not capturing that, and I can't even tell you where does it start exactly. I would love to tease that out. And my main problem is I haven't had the perfect data, so I kind of try to play a little bit around. Is there some discontinuity in the weighting around 18, or can I take account of your parents? But I don't have a good long-term panel data set where I've been able to study it so far. The SCF is repeated cross-section. If you find that data, please test your question by all means. I think it would be super interesting to know how long it lasts back. And then basically you will be able to answer why the Germans are so obsessed with inflation, right? I wasn't born in 1923, I promise. And so why is it that I'm still affected by it?
I'm thinking of an alternative explanation for the phenomenon you think traditional economics cannot successfully explain, that the generation that experience some bad time will take more conservative behavior than other generations who haven't experienced that. So I'm thinking of if we assume that people's has increased marginal disability from experiencing bad things, then despite they have the same belief, they may still take more conservative actions. Right, so have you thought about that explanation?
Yeah, so tell me if I'm not capturing something you said, but for yours and many close relatives of the explanation you're proposing, I think what helps me a lot is that I can even have two generations experience the same shock. And then, however, I predict that the young will react much more strongly than the old. Right? Because they have had a shorter lifetime so far that's seen all they've seen in their lives, while the older generation is averaging out with other experience. Then, of course, I need to control again for income, wealth, etc. But in terms of an immediate effect on your marginal utility from that experience, that for sure we can rule out. And I can talk about some refinements if you have a variant in mind.